Who regulates mortgage rates in African countries? In most African countries, mortgage rates are regulated by the respective local financial regulatory authorities or central banks. These institutions play a crucial role in overseeing and managing the financial landscape within their jurisdictions. By setting and monitoring mortgage rates, they aim to ensure stability and fairness in the housing finance market. The regulatory bodies take into account various economic factors, including inflation rates, economic growth, and market demand, when determining the appropriate mortgage rates. This approach allows them to make informed decisions that align with the overall economic health of the country. Additionally, these authorities may periodically review and adjust mortgage rates to respond to changing economic conditions. It is important to note that the specific regulations and mechanisms for setting mortgage rates can vary from country to country in Africa. Some nations may have centralized regulatory bodies, while others may distribute this responsibility among regional or local authorities. Regardless of the structure, the primary objective remains to strike a balance that benefits both borrowers and lenders while fostering a healthy real estate environment. In certain cases, international financial institutions and organizations may also influence or collaborate with local regulators to shape mortgage rate policies. This cooperation can bring in expertise and best practices from the global financial community, contributing to the effectiveness of the regulatory frameworks in place. Who has the authority to set interest rates? The authority to set interest rates in the United States lies with the Federal Reserve, commonly known as the Fed. The Fed employs various tools to influence the economy, with a primary focus on the federal funds rate. This rate represents the interest at which banks lend to each other overnight to meet reserve requirements. The Federal Open Market Committee, FOMC, is the key decision-making body responsible for establishing the target federal funds rate. Comprising the Board of Governors and 5 of the 12 district bank presidents, the FOMC meets regularly to assess economic conditions and adjust interest rates accordingly. Apart from the federal funds rate, the Fed also plays a role in determining the discount rate. This rate represents the interest at which banks can directly borrow funds from the central bank. By influencing these rates, the Federal Reserve aims to achieve its dual mandate of stable prices and maximum sustainable employment. The Fed's decisions on interest rates have broad implications for the economy, affecting borrowing costs, investment decisions, and overall economic activity. Through a transparent and data-driven approach, the Federal Reserve strives to balance economic growth while guarding against inflationary pressures. Who makes key decisions about interest rates and the money supply? The Federal Open Market Committee, FOMC, is the entity responsible for making key decisions about interest rates and the money supply in the United States. Comprising the Board of Governors and 5 of the 12 district bank presidents, the FOMC holds regular meetings to assess economic conditions and formulate monetary policy. The FOMC's primary tool for influencing the economy is the federal funds rate, which it sets as a target. This rate, representing the interest at which banks lend to each other overnight, has a ripple effect on various interest rates across the financial system. By adjusting the federal funds rate, the FOMC aims to achieve its mandated objectives of stable prices and maximum sustainable employment.